Thank you for joining us today. My name is Matt Hill, and I'm a financial planner here at Arnold and Moat Wealth Management. And our topic this month, you might have guessed it, is looking at the new tax bill, the one big beautiful bill, and looking at the really wide range of impacts that this is going to have on a lot of people. And so just to start, I'm going to go over a few slides covering some of the big, broad changes to the tax bill that we've seen. And then we'll get into some really specific examples so you can see how this bill creates some really interesting tax planning scenarios. For those of you who have watched our breakdowns of prior tax bills, this disclaimer might look familiar. I just want to say that these bills are massive, many hundreds or thousands of pages. There's a lot of information in this bill that we're not even going to be able to touch on today. What we're trying to do here is highlight the parts of the bill that we think will have an impact on our clients' financial plans and present some opportunities to plan around. I'll just say clients know that this will be on our fall meeting agenda if there's some impacts to you. We know there's lots of questions about this bill, and so we want to get some information out there right now for those of you that are interested, but know that nothing is urgent here, and we'll talk through the parts of this bill that impact you later this year. But just to give an example of the wide variety of changes that can be in a bill like this and why we can't possibly cover all the changes, I put here at the bottom just one example of text from this bill. It's changing the amount of business meals that are tax deductible, but only if that meal is on a fishing vessel or at a fish processing facility north of 50 degrees latitude and away from a major city or metropolitan area. And so now, if you run a company that does business lunches on your fishing boat in Alaska, this is probably one of the most important parts of this bill to you, but we'll be here all day if we talk through every single change like this. And so just know that we're covering the things that we think impact the most amount of people. There is a lot, though, that impacts very small segments of people, very kind of niche areas of the tax code. And that's where we'll be talking specifically to you later on about. But so instead, we're going to focus on most of our time on the parts of the bill that have wider impact. Things like the federal income tax brackets. And this law is extending the tax brackets that we know of now permanently. You might recall if this bill was not passed, these tax brackets were set to revert back to how they were before the Tax Cut and Job Act in 2017 or so, and would have resulted in some higher tax rates for most households out there. There's also a slight change to these brackets. This bill expanded the 10 and 12% brackets and narrowed the 22% bracket just by a few percent or just by a few $1,000s. And so just know that you'll have a few $1,000s more that will fall into these lower tax brackets, which is kind of nice. Shown here are the tax brackets for 2025. And one thing I note right away is that it seems likely after another year of just general inflation adjustments to these, you might notice a married couple with $100,000 in taxable income in 2026 may very well see all of that income fall within the 10 or 12% brackets now. That's 100,000 in taxable income. So, your gross income minus deductions or the standard deductions for most Americans. But that's just kind of a notable high level view of how your income is going to be taxed. And, a big part of what determines how much of your income is taxable are the deductions. And the standard deduction amounts are changing pretty drastically as well with this bill. In general, the standard deduction is increasing by $750 for single filers, $1,500 for married couples. So it'll now be $15,750 for single filers, $31,500 for married couples. And you might remember that if you are over age 65, you get $2,000 on top of that if you're a single filer, or $1,600 per spouse if you're age 65 and married. That smaller age 65 deduction still exists, but they've added a new deduction for those age 65 or older that sits on top of that. And this new deduction is called the enhanced senior deduction. It's an additional $6,000 per person over age 65. So 12,000 in additional deductions for a married couple. However, this new enhanced deduction is not available to everyone. You need to have an AGI or adjusted gross income under 75,000 if you're single or 150,000 if you're married to get the whole amount. And as you earn more than that, every dollar you earn above those limits will cause you to receive less and less of this deduction until you hit income of 175,000 for a single filer or 250,000 for a married couple. And at those income amounts or higher, this special $6,000 deduction is gone. But for those who have income below that phase out range and who are 65 or older, I put here the total amount of deductions that you are eligible for without having to itemize your taxes at all. For a married couple, it's $46,700. So remember in the last slide, I mentioned that 100,000 of taxable income may fall entirely within the 10 or 12% brackets. That 100,000 was after these deductions. And so really, we're talking about a married couple age 65 or over having total gross income of $150,000. More than that if some of this income's coming from Social Security, right? Because not all that income's taxed. But 150,000 of gross income all falling within the 10 or 12% bracket. And so just one final note on this new deduction. It's currently only in the law until 2028, and then after that is slated to go away. So maybe there's a decision here if you're 65 and considering some Roth conversions, for example, maybe you just want to consider if holding off on a few years of big Roth conversions is worth it, get this deduction, and then resume some larger conversions in 2028 or later. There's no right answer here, of course, for everyone, since the benefit of Roth conversions can vary person to person, but that's just perhaps something to look at right away. And speaking of deductions here, now to clear up just a few misconceptions from the bill. You may have received that email from the Social Security Administration talking about this bill and its impact on Social Security benefit taxation, or maybe you just read the press release like the one we're showing here that really seems to imply that the bill removes taxes on Social Security, and that is just not happening at all. They're using this new enhanced senior deduction, as we just described, and saying that that new deduction will result in Social Security not being taxed for the majority of Americans. And while that might be true for many of you listening, that is very different than saying no taxes on your Social Security. And so, just to clear up a few things, that enhanced senior deduction is available to you whether or not you've claimed Social Security. You receive that benefit whether or not you are on Social Security. And so, the benefits of delaying your Social Security are still there. You're not going to give up or miss out on this tax deduction by not claiming Social Security. And for most of you listening here, you will still be taxed on your Social Security benefits. 85% of your benefit is taxed if your combined income is above $44,000. And just one more kind of misconception to clean up here. There is a provision in this bill that is being marketed as an elimination of taxes on tips and overtime. But there's a little bit more you should know about this if it applies to you. For example, for tips, there's a maximum deduction that's $25,000. That deduction phases out at a certain level of income. And while tips may be tax-free in terms of the federal income tax brackets, other taxes are still going to apply, such as FICA, the Social Security, and Medicare tax. And so finally, I'll just say that IRS guidance will be needed here to figure out exactly how this is going to work. It's only going to apply to certain industries, for example. And so, don't expect to be asked by your financial advisor for tips anytime soon because it's going to be limited pretty strictly on who can qualify for this. And same on that overtime or the no tax on overtime clause here. There's some similar fine print on this as well. There's a maximum deduction amount. There's an income limit to be eligible to this. FICA taxes are still going to apply. And perhaps the most confusing part is that this no tax clause really only applies to the dollars that are excess from your base pay. So if you earn $50 per hour, and your overtime rate is then $75 an hour. If you work an hour of overtime, you will only receive federal income tax deduction on that $25 difference from your base pay. You still pay FICA taxes on the full $75. You still pay income tax on that base $50. And so I should have pointed this out on the last slide as well. These rules are only in the law for a few years, so through 2028, and then they're set to go away. On to the next big topic that applies to a lot of people out there. This is on the topic of charitable giving, and it saw some really interesting changes. So note before I get going that these are permanent changes, but they don't take effect until next year. And so this does not apply for your 2025 taxes this year. The first big change is the return of a special charitable deduction that's allowed for those who claim the standard deduction. You might remember something like this was enacted during COVID, where they allowed for a smaller, I think it was $300 or $600 deduction that was available for you, even if you just claim the standard deduction. Now that idea has returned and it's a bigger amount. And so beginning in 2026, single filers will be able to get a $1,000 deduction for charitable contributions, even if they do not itemize and just claim the standard deduction. Married couples get double that, 2,000. And so that's a really nice feature for those that typically give around that amount regularly, but don't itemize your deductions. You can help knock off a few $100s from your tax bill for the donations that you like to make here. There's a couple slightly negative changes as well to charitable deductions, particularly those who itemize. And so first, there's a new 0.5% AGI floor to the deductions that you can claim. And so, just for example, you only receive a deduction for charitable contributions that are above 0.5% of your AGI or adjusted gross income. And so just for example, if we have a couple that has an AGI of $200,000 who donates $10,000, they will only receive a deduction of $9,000 in this case, because you can only deduct charitable contributions that are above 0.5% of your AGI. So in this case, $1,000. That change makes QCDs all the more important for those over age 75. They are still going to be very likely the best way for you to contribute to charities because you just get that full dollar amount from the QCD as effectively as a deduction since that income never really hits your tax return. Also, this makes donor advised funds or DAFs slightly more attractive as well. Generally, with a DAF, you're lumping together multiple years of donations to get kind of a larger deduction in a single year. And by using a DAF, you only need to clear that 0.5% AGI floor once rather than every year. And so if you're used to giving something like $4,000 or $5,000 a year, you're going to see this reduction in your contribution every single year because of this new AGI floor. If you use a DAF and just say maybe you give 25,000 every 5 years instead, it's going to result in bigger, larger deductions for you. I'll just end this by saying that charitable contributions and the strategies are more complicated, and there's definitely value in taking the time to figure this out in the most tax efficient way if you're charitably inclined. There's two quick notes on the boxes on the right-hand side. One is just to make you aware of a new tax credit that's available in 2027 for donations that are made to what's being called a qualified elementary or secondary education scholarship. I'm not going to talk about this a lot since it's a couple years before it comes into effect. But if this is something you have been contributing to or know you want to contribute to, know that in 2027 there's going to be bigger tax benefits for contributing up to $1,700 then. And then the red box here is a quick note for those in the highest federal tax brackets who are charitable. If you're in that 37% federal tax bracket, beginning next year in 2026, you will only receive a deduction on your charitable contributions at the 35% income tax rate. So effectively, 2% less in deductions. So if you're planning on some big gifts here and you're in that top income tax bracket, there's definitely some incentives to get those gifts in this year rather than next year. Okay, before we kind of cover some more changes in the bill, I thought we've covered enough here where we can show a couple of examples of how this new tax bill impacts, a couple example households and just kind of see some of the tax planning strategies that are created because of this. Because one thing that we're seeing in this tax law is that there's a few new tax traps, so to speak, that can cause households to be in a much higher effective tax rate than they might think they are just by looking at the federal income tax brackets. And so, just for example, let's look at a person age 65 here with some income that comes from, maybe overtime or tips. That person recognized 70,000 of capital gains for this year, maybe from some stock sales. And then this person has a lot of deductions as well. They benefit from a large state and local tax deduction. They contributed significantly to charity. They had some high medical expenses. And remember, there are a lot of expenses that can fall into this category: dental work, hearing aids, long-term care insurance premiums, money you paid out of pocket before you hit your out-of-pocket max. And so, this can add up to a lot of money, a lot of deductions for certain people. Anyway, and so this person might be thinking that with all these deductions and the new tax deduction on tips and overtime, that new age 65 enhanced senior deduction, they'd be very right in thinking, wow, I'm only in the 10% federal income tax bracket this year. I should do some Roth conversions and at least fill up that 12% bracket, right? And with those numbers, this person would be looking at a Roth conversion of about $37,000 to fill up the 12% bracket. And that low tax rate should be a no-brainer, right? But what we're seeing is that there's a lot going on here. And this chart, what we're trying to show here is the effective tax rate on additional income. And so the y-axis is the effective tax rate, the x-axis is additional income here. And so just for example, what we're trying to highlight is that 37,000 extra dollar that they earn is going to be taxed at an effective federal tax rate of 38.4%. This is just federal taxes, by the way, so we're not considering state taxes anywhere. And so how can a person in the 10% bracket be getting taxed at 38%? And well, the additional income from Roth conversions would push some of those capital gains from the 0% tax rate to the 15%. The income from the Roth conversions would cause this person to lose new tax deductibility from overtime and tips. The new charitable deduction adds a small effective tax increase too, just clearing that 0.5% of AGI hurdle. The net investment income tax is triggered. On top of that, IRMA's triggered. And in total, this person would see that $37,000 Roth conversion result in about $15,000 more in taxes and Medicare surcharges, which is more than a 40% effective tax rate. And now this is just an example, obviously. I'm just trying to highlight some of these complex tax rules and how they're being stacked on top of today's current tax rules and opening up a lot more of these types of scenarios that make tax planning just incredibly complex. We could look at a retiree now, for example, and show the impact and phase outs of other tax deductions. So here now we're looking at that same 65-year-old, but who's retired, who's on Social Security, who takes some modest IRA withdrawals and recognizes some capital gains as well. And like before, they take a sizable amount of deductions that I've listed here. We're going to talk about that new auto loan interest deduction in a future slide. That's something new from this bill. For now, just kind of take this list here as deductions that they're eligible for, and we see a very similar trap here. Despite being in the 10% federal income tax bracket, this person would see a 36% effective tax rate after accounting for the loss of that enhanced senior tax deduction, the loss of auto loan interest deduction, capital gain taxation, and more. And so the new tax law is not the only reason this is happening. To be fair, this existed to some extent before the bill. But now we're adding to it. In this scenario, for example, this new tax bill is adding about a 7% effective tax rate to this retiree's Roth conversion plan, just for example. And another really big change from this bill is an increase in the amount of state and local taxes that you can deduct on your federal return. These are known as SALT taxes, and they'd previously been capped at $10,000. This cap really limited the amount of deductions for those who live in high tax states or those who had very valuable homes that had a lot of local property taxes on them. And so this law is raising that max up to $40,000 now, starting this year. This $40,000 will not adjust to inflation. Instead, it's just it has a 1% fixed increase every year going forward. And then in 2030, it's scheduled to go back down to that $10,000 maximum, back to kind of what we had last year. And what's also interesting here is that there's an income limitation to be able to claim this $30,000 in deductions. So for single filers, you start to lose this deduction as your MAGI goes over $250,000. For married couples, you begin to lose this deduction as your MAGI rises over 500,000, and it completely phases out after an additional 100,000 in income. And so if you have 100,000, if you have 600,000 in MAGI as a married couple, all you can claim is the $10,000 SALT tax deduction. You can't claim that full 40,000. And so this opens up a really interesting scenario for those who have high income and can maximize these SALT deductions. There's a place in the tax brackets here where basically $100,000 in added income is going to lead to taxes on $130,000 in income because you're losing out on $30,000 in SALT deductions, effectively potentially adding more than $45,000 to your federal tax liability from $100,000 in income. And again, this is before any state taxes. And so just to look at an example where this applies, here's an example of a worker with high income who had high taxable income, maybe from just a high salary, maybe from some stock options or grants. This person also had some inherited IRA withdrawals. Maybe they're navigating that 10-year required withdrawal requirement, and they recognize some capital gains. Um, and on top of that here, let's see, they took the maximum SALT deductions we just talked about and did $20,000 in charitable contributions as well. And so what is this household's effective tax rate going to look like on additional income from here? For this example, that additional income this worker receives over the course of the year is going to be taxed at an effective tax rate as high as 52%. Again, this is without any state taxes. If this person was in California, for example, they'd be adding another 11% or so on top of this. And this person would certainly be in a position to want to think about some tax planning, right? What can they do to have income not fall into this high of an effective tax rate? Maybe it's something simple like moving workplace retirement savings, that could help a little bit. Maybe it's trying to defer income from some stock options or things like that for longer if you can. Maybe this just gives you an excuse to pull back from work a little bit if you're at this high level of income because of very long weeks, lots of overtime. Maybe just seeing that you're at a 60% or more effective tax rate is enough to kind of nudge you back and take some time off of work, enjoy some of your life outside of work there. And so, there's lots of options here. Again, we're just trying to show some of these new planning opportunities that are arising from this tax bill. Now I want to move back into just a few other big changes from this tax bill and just briefly highlight how some of these might impact you. I think going forward, some of the changes we talk about are not going to be as broad in who they impact, but for those that are impacted, there's going to be very significant changes to your taxes. And so first, let's look at those that receive tax credits on their health insurance premiums. This is those that purchase policies on the healthcare.gov exchange. One positive change is that bronze plans will now be eligible for HSAs or health savings accounts. This can be a nice feature for those who have the ability to fund these, build up that as tax advantaged accounts going forward. But most of the changes here are going to negatively impact you. There's some administrative updates, such as canceling auto renewals. So you'll want to make sure that you're going in and electing to renew your policy so that nothing lapses. But the biggest change here is the reduction in tax credits that are going to be available. The Inflation Reduction Act added to these tax credits, and now that's all going away. And in addition to some of those added tax credits going away, that there's a cliff here where a certain amount of income is going to instantly make you ineligible for any tax credits. They're kind of changing up how your income qualifies you for certain tax credits available. That income amount depends on the size of your household and where you live. It's defined or it's set at 400% of something called the federal poverty level for your household size. Again, this is going to vary a little bit, but for a household of two here in Iowa, that's about $84,000 per year, but it will vary depending on where you live. I put a table here showing the impacts on the tax credits a household would be eligible for as their income increases. A big caveat here is that these numbers vary depending on your state, and the 2026 numbers are just an estimate because we don't know for sure the cost of these plans next year yet. And so use this as an estimate. It's hardly the exact number you might see. But the important thing to realize here is see the impact that cliff as your income crosses over that 400% federal poverty level threshold, you will instantly lose all of your tax credits. There can technically be a situation here where $1 in income instantly costs you, $10,000 in tax credits. And so for some of those people that are on these plans, have income close to that 400% level, this is going to be a very important thing to know about and plan around. It's going to create some um, really important tax planning opportunities for those in this plan. It might be worth, possibly taking extra income here now in 2025. When that cliff doesn't exist, you'll lose out on some credits this year, but if you can ensure you'll get some credits going forward, it might be worth, selling some more stock, taking a little more income to build up your cash reserves, going forward. Another big topic that we'll just cover at a high level here is college planning. First, this bill further expanded the definition of qualified expenses to be able to use your 529 for. This is really just continuing a trend that we've seen over the past few years as they make these accounts more and more flexible for those who are in private schools, those that do trade schools, and some non-four-year degree education programs. Also, there was a limit of $10,000 in annual expenses for these non-college tuition type of expenses, and that's being raised to $20,000 now. So if your child or grandchild is in an expensive private K through 12 school, has a lot of other fees or expenses that would qualify. I tried to list a few here. These 529 accounts are going to be even more valuable now. And then finally, we're awaiting some final clarification on this. But to some extent, 529s are going to be able to pay for post-secondary credentials as well. For our industry, this is things like the CFP or the Certified Financial Planner designation. But I think this is going to apply to many others like SHRM for HR professionals, CPAs, etc. If this applies to you, I think this will be really interesting since it's effectively making 529 accounts applicable for just about someone's entire life, right? From the day you're born, a 529 account can be used to save for future expenses. And then until the day you retire, it can help pay for these ongoing expenses to keep up your professional designations, continue that continuing education, and so on. Moving on, some big changes if you're planning on buying a EV, electric vehicle, or doing some energy efficient updates to your home. All of these are going away, but slightly different timetable for when they're being phased out. And so the shortest timeline here is the electric vehicle tax credits. That's that $7,500 tax credit available to you up to $7,500. You have only about 2 months now to purchase a card to qualify for that credit. Beginning October 1st, that is going away entirely. Then the home improvement related items are done at the end of this year. And so this is solar panels, heat pump, geothermal systems, energy efficient doors and windows, etc. If you had this on your to-do list to get done, don't wait much longer because these have to be either in service or paid for by the end of this year. One brand new item from the tax code here is that interest from certain auto loans is now going to be tax deductible. This is only for loans on new cars purchased in 2025 or later. However, it does appear that if you refinance a loan on a new car purchase you made before 2025, that new loan would qualify for this. There's a maximum of $10,000 in interest that can be deducted. It's probably not going to be reachable for most. That'd be something like a $200,000 in car loans at today's interest rates, but there's a max there. What's important to know are the requirements. I'd just say, ask your car dealer here to make sure that the car you're buying applies. But general rules, the car must be assembled in the US, legal to drive on streets, and under a certain weight. And so things like RVs, ATVs won't count here. And I don't know if this is going to be enough to really cause anyone to drastically change their plans, but just for an example here, a pretty decent car loan, let's say $50,000 car loan for a family in the 22% tax bracket. This change would amount to tax savings of about $700 or so in the first year of your car loan. And so it certainly helps if you were planning on buying a car or have a car loan that you can refinance and fall into this category. Better than nothing. One other brand new thing here is a new type of retirement savings accounts created as part of this bill. These are called Trump accounts. I'm not going to go into a lot of detail here because these are not going to become available until 2026. You can't do anything with these accounts right now, even if you wanted. It's going to take a lot of time to get the infrastructure set up for these. We also need a lot of clarification from the IRS on how these are going to work exactly. But for now, just as a very high level review, know that these are basically IRAs for children. Parents can contribute up to $5,000 per year. It's not deductible at all for the parents. The government will contribute $1,000 to accounts for children born in the next few years, just as kind of a pilot program. And that money can be invested and it can grow for many decades. At age 18, though, the account legally becomes the child. And so the parents will have no say on whether or not that money stays in the account or not. And withdrawals act just like the IRAs we are used to today. Any earnings on the investments will be taxed like income. And there's a penalty if money is withdrawn before the age 59 and a half. So maybe I'll stop here before getting into a lot of the details, some planning considerations on whether or not these make sense for you to contribute to. Just know that this will be a webinar topic in the future, and so we'll dive into all the considerations of these accounts in the future. Finally, just two slides left here, really just to raise awareness for some of the big changes for business owners here. I'm not going to go into a lot of detail. If you have a business, particularly a business that has a lot of deductible expenses, so a lot of very capital intensive, R&D intensive. Definitely talk to a financial planner or CPA about these. There's a lot of advantageous changes around these deductions and tax benefits that business owners or workers at small companies might be able to benefit from. And likewise with college planning, there's a few changes to FAFSA. It's reverting some of the changes from a couple of years back on what assets negatively impact your financial aid. And also some changes on the college loan side as well. There's new maximum loan amounts that you can take out. There's new repayment plans that you should be aware of. And again, for those just out of college or parents looking to help finance their kids' college expenses, this is going to be a very valuable topic to work through the details of. I probably won't go through a lot of details here just for the sake of brevity, but just to highlight, that this is an important change for a select group out there. And so I just want to end with a very similar disclaimer as to how we started. There is a lot to this tax bill that we didn't cover. Things like raising the estate tax exemption to $15 million. This is something that was scheduled to drop to about 7 million, I think. And so this is an incredibly important change for, households that were maybe around $10 million and really wondering whether or not these estate taxes were going to start impacting them. I think this impacts about 0.3% of households in America. And so for those 0.3%, very, very important change. I didn't go into a ton of detail here just because for so many, it doesn't have an impact. Lots of other small changes that will impact your taxes, child tax credits, how much mortgage interest you can deduct, alternative minimum taxes, some big changes for real estate investors. We'll be walking through all these parts of the bill that impact you directly this fall in our client meetings. But hopefully this was helpful just for a high-level overview of this bill, give you a glimpse of some of the topics that will be on our fall meeting agendas. If there's anything we didn't cover that you have questions on, please send us an email or give us a call. We're happy to help out however we can. Thanks again for tuning in, sitting through this a little bit longer than normal webinar. Look forward to talking with all of you later this fall about this. And if there are no questions, have a great weekend and thank you.